Welcome everyone to a new video. In today's video we look at the possibility for the Fed whether a recession can still be avoided. It seems almost impossible to find a scenario where inflation does not fall downward. We see it almost in all forward-looking data models. Yet the situation with the Fed is still the same, continuing until demand is destroyed. A soft landing thus seems out of the question despite what they say. But before we can continue with this update, make sure to hit that like button and subscribe to this YouTube channel. If you enjoy the content, also make sure, as you might know, we have removed the paywall on our trade letter, and the trade letter is completely free, where you get the latest information about crypto, trading and investing 3 times per week. Check the link in the description beneath. Also, make sure to join Bybit, as we can give away 1 month of premium membership if you do. Last month we've made 11% in profits on the portfolio. Want to check that out for 1 month for free? Join our link on Bybit and you will be added. In today's video we are going to walk through some of those data models to compare what the current picture is telling us and whether the data agrees with what we get out of the media. We'll start with food, as food prices have been accelerating. Obviously, people around the world, especially in Europe, are not happy with the huge price increases around food. In the Netherlands, it looks something like you can see behind me. The highest percentage increase and largest rate of change ever. This fits well with the picture of the world. Daily grocery shopping has become incredibly difficult for most of the people, and more people are getting into that stage at this point. The FHO food price index has already dropped about 15%, creating easing pressures on the end consumer. We also know that this data normally lags behind reality, so we can expect a further decline to happen. Do we remember the supply chain crisis of 2021? It is long gone. We see in today's data and also in forward-looking data, and on this channel I've often been talking about PCE numbers. The nice thing is that we can also see that some indicators based on correlation can predict the PCE number. In the following image you can see the domestic freight rates in dark blue running down hard, and these have lead time of 3 to 4 months on the PCE numbers. We look at wages to see if households, one of the weakest links in the economy, can keep up with inflationary increases. But as you can see in the chart next to me, you can see that salaries are already falling again. Purchasing power is being destroyed, which then causes a further decline in demand for goods and services and food. Salaries always seem to follow job openings in the data, and these remain just sky high in the current market. But we also know that in the current world of working from home, double posting of jobs is used, so it seems that the labor market is good, but it's actually about double counting and it's giving you wrong data. Now, if we compare these two variables, we can see that the number of job openings is decreasing in concert with salaries. If this trend continues, there will be a big spike in unemployment next year in 2023. Regarding unemployment, we have already gotten data earlier on that. The unemployment slowly starts to rally, as last month's data has resulted in an increase from 3.5% to 3.7%, in which the unemployment data starts to show signals that the Fed most likely can't keep up the policy that they are looking for, as multiple people have been initiating a potential pause on the assets already. In that case, it's important to keep an eye on the yields as well. Food prices have been rallying, but also goods have been rallying in prices. However, the amount of sales haven't been following through that much. The yields, which are determined around the federal funds rate, as these are most often used to derive the nominal rate that banks can use to borrow and what interest needs to be earned on government bonds. At this point, as the chart shows, the yields are running in a massive manner. This will impact all businesses and all prices, however it has a lag. The actual impact of a rally of the past 4 or 5 months will be taken into account in a few months' time. That means that we could be getting into a period where inflation is going to fall off a cliff and deflation comes around. Temporary deflation due to the immense shocks which the markets are going through. We started with COVID-19. Now we are at peak inflation due to the impact of all the money printing caused by COVID-19. We've got an energy crisis, China crashing down and more. It's just a matter of time until the tables will be turning, so it's crucial to keep a focus on the inflation and deflationary data when it comes to building your portfolio. So, what can we conclude from these data points? After all, I chose them for a reason. We can see that in addition to the energy prices I covered the other day, the inflationary pressures are decreasing almost everywhere. Today we discussed the case of food inflation and that it looks positive for the economy. Then, if you want to get the economy going again, the transportation of goods, which we have been discussing, and services will have to get going again. In the data we mentioned, we see that supply chain pressure is decreasing to the extent that it's providing relief everywhere. And we have also been seeing that inflation has been dropping a bit, which we are getting reflected in the PCE data, which will be happening more in the coming months. In short, inflation is decreasing. But the Fed is continuing, even so much so that while the economy is already starting to look better, companies are going broke and thus job openings are declining and salaries are falling. So we can conclude that things are actually improving, but the Fed is not reading these data correctly, although they remain data dependent, which is obviously a bit weird. As a result, we end up in a scenario where if you wait for lagging data to show the right numbers, you end up in a recession that might have been prevented at the first place. But then we really have to go down the line a lot. The question is, are we going to get a soft landing? Only a very slim chance of this being achieved, and we already see that in the data. In today's video, I gave you an outlook on the current economic status based on some key data points. We know that the economy is deteriorating rapidly, but policy is actually made by the Fed, and our job is to deal with that properly so we have a proper investment thesis when we go forward. Now that you know what's going on, we can anticipate this together. That's what I like to do on this channel, and that's what I like to explain towards you, and also deduct that from all the thesis that we do with investing. In the coming videos, I will continue to keep you updated on this situation. For now, thanks for watching. Don't forget to leave a like below. Don't do anything stupid, and I'll see you again soon on the new content that we provide on this channel. Ciao!